recent years, despite temporary difficulties, the market has held up quite well. But because of recent events, I started to wonder what if tensions continue to rise and this year or next year will be different. What if something actually happens that stops economic growth and maybe even causes a crisis? That's very uncommon, right? Well, there are many examples this year. The war between Israel and Iran, it didn't last long, theoretically, true, but it only confirmed the direction we are headed. International tensions are constantly growing and it's not good for the global economy. There's not a war going on in this region. This one is Gaza. However, it may end if the recently signed ceasefire somehow turns into peace, at least for a while. And do you remember the recent conflict between India and Pakistan? Everyone has forgotten about it. The fighting has stopped, but there is no lasting peace, unfortunately, and all it takes is a spark to start fighting again, increasing tensions in the world. Without leaving the war topics, we still have the protracted war in Ukraine, which doesn't give much hope for a quick, peaceful resolution. However, the war also works to the advantage of some. For example, the arms sector, which has gained a lot since the beginning of the war. If the conflict continues, it will probably continue to gain. However, the end of the war would have a very positive effect on the overall market, giving investors more hope that the world will not escalate into major wars. But again, there's not much chance of change here. The tariffs imposed on almost every country in existence by the Trump administration did a lot. Liberation Day did not please the market. S&P 500 down by 11%, stocks down, cryptocurrencies down, gold down for a while but then gained. We'll come back to this. Almost everything was losing. People thought it was over. The media were screaming that the whole market in the US would collapse. As you can see, not yet. It was certainly not a decisive blow, more of a building block to the overall picture of a situation. Just as the tariff war with China led to uncertainty in the world, the very loudly announced tariffs of 145% in practice made any trade between the two countries unprofitable. It ended quite quickly with a reduction in tariffs to 55%. Despite everything, according to the analysts, it still had a strong negative impact on the economy and may have a long-term negative consequences for us. Due to growing uncertainty, the FED has kept interest rates unchanged, and it doesn't seem to be in particular hurry. High rates mean expensive loans and fewer people willing to invest large sums and drive up prices. Powell and other FED members appear to be waiting until the end of the year to decide on a rate cut. At least that's what JP Morgan analysts say. Furthermore, their forecasts predict a significant chance of an economic slowdown this year, with a recession of up to 40%. This is primarily due to the factors mentioned earlier. However, I advise you to approach such reports with a grain of salt. The world is full of unforeseen events, and forecasts from even reputable companies often fail to materialize. For example, in February 2025, gold was expected to gain 8%, but it has already exceeded Goldman Sachs' expectations twice. Despite this cautious approach, you still need to be prepared for a potential crash because, believe me, it never comes with a clear warning. It's easier to analyze warning signals after the fact, not before. But coming back to the title, what can you actually do to avoid going broke in an economic crisis? Whether it's boom or bust, a financial cushion is key, a readily available sum of money that will keep you going for a few months in case of unforeseen problems. In this video, I wanted to talk about savings we don't necessarily need right now. While it's impossible to dynamically grow your capital without any risk, there are still proven ways to maintain the value of your savings despite inflation and even grow them without fear that some negative event will cause panic and wipe out your entire account. And this is only my opinion, not advice. I believe there's no point in overthinking things, and it's enough to focus on a few well-known assets. Gold, considered by many as a safe haven, this isn't far from the truth, as people flee to it when the stock market crashes, inflation rises, or conflicts erupt. However, it is the most volatile asset on the list. Gold's volatility can even be compared to that of stocks. For example, if you bought it in 2022, you could lose almost 22% at one time. Which doesn't mean it reacts to conflicts the same way it does to stock market actions. Quite the opposite. It gains value when trust in currencies and governments declines, when conflicts break out, or when anything else happens that increases uncertainty. It can't be printed, it doesn't rust, and it cannot go bankrupt. You can own it physically in bars, coins, or even jewelry. You can take it wherever you want, and you're not dependent on anyone or anything. Physical gold isn't for everyone though, and a small investor is unlikely to feel comfortable with it. A 1-ounce coin costs $3,650 at the time of recording, and while there are coins with lower weights, they are generally less cost-effective because their price includes a higher minting fee. An alternative for those with smaller budgets is gold ETFs. In practice, you're buying a document that makes you a legal owner of a portion of gold stored somewhere in a vault in the UK or Canada. But there's one catch: if for some reason the company managing the ETF goes bankrupt or the broker you bought the gold through goes under, you could lose your assets as well. This is a major risk if you go with a large fund like BlackRock, for example. To sum up, gold doesn't work for you by generating a percentage return like stocks do. It simply exists. Its main role is to protect the value of your money in times of crisis. In case of crisis, it's also worth having bonds if you're worried about gold fluctuations. Bonds are tools through which the US government borrows money from citizens. You give them, for example, $100 for a year, and after a year, they will give you back your $100 plus 2% of that amount, which is $2. You can choose from short-term, medium-term, and long-term bonds. The shortest bonds don't pay you interest, and you earn money by buying them at a lower price than the government will buy them from you. Why might you want to buy them? If you want to prevent inflation from systematically eating into your savings and want to keep them for a while, they will do the trick. Each of those bonds can be sold early on the secondary market, but they are listed. So back to the gold example, their price can rise or fall, so you can get rid of them early for profit or loss. Simply put, their price depends on the current interest rates. When rates rise, bonds prices fall, and vice versa. And we're left with the investment your parents probably recommended: a bank deposit. It works similarly to the bonds described earlier. You put money in for a certain period of time and receive a fixed interest rate. The difference is that you're giving it to the bank, not the government. So it would be better if it didn't go bankrupt. Deposits can even provide some real profit, as the current interest rates at some banks exceed inflation. This means that your money not only doesn't lose value, but it earns money. And where's the problem? Long-term deposits are risky. Inflation can rebound and early withdrawals can be punished by losing a significant portion of the interest. A short-term deposit might be the solution, likely with lower interest rate, but also with less risk, and we want our savings to at least retain their value. The dollar can also depreciate, so you might want to protect yourself against that as well. The solution is simple: other currencies, and I'm not talking about cryptocurrencies, but rather other major currencies in the world, like the euro or the Swiss franc, etc. If you're genuinely concerned about the dollar depreciating, it's worth having some euros and francs and cash just in case. The solution could be a combination of these approaches. For example, 20% of your savings in gold and 80% in bonds or deposits. There's no point in being scared of crisis and thinking that it's right behind a corner. You don't know when it will happen, but it will certainly come sooner or later, as it did many times before. History shows that the market has always emerged stronger in the long run after a crisis, so I think there's nothing really to worry about. Bye.